All right, everybody, welcome. So we're doing a live stream today. We're going to be watching the Fed make their announcements of how much basis points they're going to cut today. How is this going to impact Tesla? What if it's a 25 basis point? What if it's a 50% basis point? We're going to watch this live. We're co-streaming in our 3 channels. Nick from Investment Against the Grain. You got Brian White from Futuraza. So we're going to be watching right off the bat the immediate announcement, and then we'll also watch Federal Chair Jerome Powell, and we've got some slides to share with you as well of what has happened in the past for these rate cuts and what will happen to Tesla specifically, who's selling high assets like cars. Welcome everybody. How are you guys doing?
Oh man, what a day! What a day! A little under the weather, but I'm all right. How are you doing, Nick?
I'm doing good. I'm watching the stocks are starting to move.
But which way?
Oh, tell us what's happening. Yeah,
looks like a lot of up. Here, I'll go ahead and unmute it.
Inflation. We saw PPI, we saw CPI data come out. The inflation data it's coming down, but there is some sign that it might be slowing. We still think it's coming down. We don't think inflation's a big problem. Look, the Fed has to take a bet here. They are taking risk. The risk is if they don't take a big bite right now and go 50 basis points, that it could be that the unemployment rate accelerates higher, and that creates a bigger problem down the road. But the other side of the risk is that if they do go too fast and inflation then starts to perk up a little bit too high, then I think they've basically signaled to the market that they're very aggressive and that this could create a bigger problem down the road. So in my view, I think 25 basis points on a risk-adjusted basis is more warranted, but that doesn't mean that a very good case could be made for 50.
All right, Jim, thanks very much. We'll come back to you in a very short time, but we are just seconds now away from the Fed's decision on interest rates. And for that, let's go to Steve Leisman.
50 basis points, the Federal Reserve cutting interest rates by 50 basis points to a new range of 4.75% to 5%.
Yes.
There was one dissent, Fed Governor Michelle Bowman preferring to cut by 25, but 11 voting in favor of 50. It might have been close. I'll come back to that at the end of this report. The statement says the committee will consider additional adjustments to policy based on the data, the outlook, and the balance of risks. The summary of economic projections saying an additional 50 is expected or forecast by the median Fed member for this year, for a total of 100 this year. That would bring the median down to 4.4%, or an additional 50 basis points from where we are right now. Another 100 basis points of cuts expected through next year, bringing the rate down to 3.4%. All of that a bit above where the market is priced. And the new long run rate would hit 2.9%. That's up a tick by the year 2026. The statement now says the Fed is firmly committed to supporting both maximum employment and the 2% inflation target. Before and for many months before this, the Fed had relied solely on saying it was focused on the inflation target. The committee has gained greater confidence, the statement said, that inflation is moving to that 2% target, and risks to both sides of the mandate now are said to be roughly in balance. On the economic description, the economies continue to expand, it says, at a solid pace. Job gains, however, have slowed. Inflation making further progress towards 2%, but remains elevated. It's seen declining to 2.3% this year, 2.1% next year, and hitting the target 2% by 2026. Unemployment, the outlook for unemployment did tick up. I think that's important to what the Fed said here and what it did. Up 0.4 to 4.4%, 2 ticks higher than it is right now. Growth pegged at 2%, slightly above the 1.8 potential, well into 2027. Now, 9 officials in the dot plot wanted to do 75 basis points or less this year, and 10 wanted to do 100 or more. So it may have been a very close call as to what was actually wanted around the table in terms of 25 or 50 today, but they decided ultimately with 11 voting in favor of the 50 basis point rate cut. Tyler.
All right, Steve, stick around as we get back to our panel for some reaction. Claudia, you were the one who said
I don't know if you want to hear the panel, Herbert. You're the MC here. I'll let you control this.
No, that's great. No, that's fantastic. So 50 basis point, obviously that is important, right, for Tesla. Now we're going to talk about the near term versus the long term. So near term wise, this is good for Tesla, right? Which is growth companies like this. We're going to show everybody in 30 minutes from now when Jerome Powell actually comes on the screen. We will show what he says. But 50 basis point is, I think, very good point to Tesla. Here's Gary Black saying that this goes without saying, but a 50 basis point Fed rate cut would benefit long duration, high PE growth names like Tesla. So that is important. And we're going to see what's going to happen now. So was done before this today. And he was saying 25 basis point. This is what the market was expecting. If it's 50 basis point today, another 50 basis point possibly by November, which sounded like what they were saying, that the vote was happening this way, or we're headed here faster. What do you guys think is going to happen for Tesla in the near term, the next several months?
Well, looking at it right now, it's up today. What it means is the cost of financing just went down. It means that you can now extend the 0% interest rates with less costs incurred. It means you could do, 2 or 3% interest rates with minimal cost to incur. And it means that cost of borrowing generally has gone down. This will have a knock-on effect that will juice the market a bit, is my take. What do you think?
Yeah. Well, first of all, guys, can you see me clearly? I want to make sure everything's good. Okay, perfect. Thank you. Yeah. So, before I give my take on the Tesla part of it, for the last week, I've been talking about on different channels the fact that the market prices these things ahead of time. So I think the consensus over the last 2 weeks has slowly shifted to 50 basis point, and then definitely starting Monday, the odds were 66% chance of a 50 basis point. And you saw the market price that in, and you're actually seeing right now, there's essentially no real movement, right? Everything's flat. Now, Jerome Powell's going to speak, and that can always change perspective, the way he delivers, how he says something that people read into. But the point is that the market's pretty efficient. And normally, if you're betting on these kind of things, it's kind of pointless because you don't know anything that probably isn't baked in the market already. So again, that's just my point of view. So I just want to kind of further make that point with the movement right now. As far as Tesla goes, I think, I did a review of Ross Gerber on with Meet Kevin last week. And Ross Gerber was saying that, because Tesla's doing all these 0% interest rates, that when the Fed cuts, that Tesla doesn't benefit from it, because they've already pulled all that demand forward. And that's I don't know how else to say it, but that's stupid, right? Because Tesla is front loading and they're the ones taking on the chin to pay down for those rates. By us having rates come down, now Tesla actually has several quivers or several tools in their toolbox, or several arrows in their quiver. What they can do now is they can choose to keep those low rates and not really have to have as big of a burden, as Brian pointed out, or they can choose to have a slightly higher rate, but still better for the end consumer, and they can pass it off as far as lowering the price of the vehicle, or they can help their own margins. So really, Tesla defended when they needed to defend, and now with the rates coming down, they can be a little more offensive because now they actually have tools at their disposal, much like the Fed, right? By raising rates, the Fed now has tools in case there's an economic issue. When we're at 0% interest rates, they had no tools. So I just think it's a very nuanced conversation, and there's a lot of implications on this. But in general, moving forward, we are in a very good cycle for any stocks or companies that are very interest rate sensitive.
Yeah. So we're well on our way, right, to this. Let me hide that banner for now. This is the expectation for the market. This is before the Fed today announced a 50% basis point. This considers just a 25% basis point in September 24. But this confidence at this point with a 50 basis point today and the vote, you saw the vote, that they are probably going to try to hit 1% basis point by the end of this year. In October, it will probably be another, 50, well, maybe not the 25 anymore, right? This is all changed, like you said, Nick. But this is heading downwards. This is the path that we're headed towards. And so what people are saying is for Tesla to not just look at what happened today, which is, I think, very good news, but what's happened to the 2-year rate, the yield rate, because that will tell you what people are forecasting in the future. That's what's important for Tesla. People will be able to buy it. There's some new stats that we've been reporting in the last 2 weeks where 1 in 5 people who are trying to buy a car today are being denied. they're not able to get loans. This is going to help that. This is a significant growth for all purchases, people being able to afford things. So I think this is good news, both in the short term and the long term.
All of it increases affordability, and that is the key. That 0.5% interest reduction does drop your car payment, maybe only 10, 20, 30 bucks, but that's real money. That's, an hour or two of wages. That's a maybe even a whole percentage point on your debt to income ratio. It can make or break a deal.
I mean, if you look at what you were saying, right? Today, you can buy a Model Y, Model 3, if they're long range and their performance, you can buy it with zero due down. This is a new incentive that Tesla did in North America, zero due. And then they're still carrying the 1.99% APR. This was a new one, zero down. And then, but you get the 1.99%. And then after September 3rd, it'll come back to 2.99%. If there's a 0.5% rate cut instead of 0.25, maybe they'll keep the 1.99% ongoing. This is the kind of things that Tesla has, like you said, in the quiver. What are your expectations of what Tesla might do with this? Will they pocket the margins? I've been saying that I don't think that they have a problem in margin. Why do I think that? Why would you introduce a zero down 2 weeks before the end of the quarter if your margins weren't strong for this quarter? If it was strong, then that's why you're going, let's go ahead and offer this fantastic to boost up volume. And they're going to have sales for the, to end the year, the quarter ending. Some people believe that this quarter will be a record quarter in vehicle deliveries. What are you guys expecting?
So the other thing worth noting is that there is a free FSD transfer through the end of the month. If you have a Tesla and you've already purchased FSD, you can carry it forward onto your new Tesla through the end of this month. That's another big benefit. That's another nice little demand lever. I would disagree with a lot of that other stuff. There's, I think that the objective is volume over margin. I think even if the margin was so that they would still want to increase volume at the very least, just so they can maintain volume pricing. When I sold Broadcast Electronics, there were companies that were selling the same thing as us, but for less than our cost. And I said, well, how can they sell it for less than we pay for it because they're higher volume? I said, why don't we just buy it from them? Because then their volume would go up even more and their price would go down even more. So maintaining a high volume is critical. It may look like you're losing money, but you aren't always doing that.
Okay. Also, just to let people know, we will be live streaming the Fed as soon as they announce what's happening. We'll play this. Right now, this is what they're showing on their website, and we'll be playing it as soon as it goes live.
Yeah, and Herbert, worst case scenario, if that doesn't come up, I can share my screen if need be. So just to look, let's not just assume that the zero down is a good indicator. That could be we have people not taking delivery, or we don't have enough deliveries to beat a year over year, right? It could be a defensive move. I don't know. I don't really have an opinion one way or the other, but just trying to, remain balanced here, that we don't actually know if that's a good sign or not. And Brian, as far as the FSD transfer, damn Tesla, they need to stop sending out emails whenever we have a lottery going on, because I saw that email come in and my eyes got big and I clicked on it. I'm like, oh, get out of here. What are you doing to me, guys?
It's easy to know how the lottery is going to work. None of us are going to win it. The odds are too low. I had a comment from someone who had worked on the Warner Brothers lot in the past who said, the entire capacity of the place is not as big as you think. It's not designed for high capacity. It's designed to look like a city. They were of the mind that there would be no way that they would have more than 600 people on the lot, which to them meant 300 tickets, which to them meant, if it's a +1, 150 tickets. No idea how accurate that is, but that was what was shared with me.
So I was going to ask you this question. When the interest rates started to rise, Tesla's obviously had to be impacted. Elon has said many times, he said the reason why we had to do massive price cuts is because people can't afford it because the interest rates went up. Okay, now that we're now flipping back, interest rates are being cut now. What is your expectations for the impact to Tesla's stock price and Tesla's sales?
All right, I'll go first. In terms of stock price, I have no idea. It's astrology. I can't read the stars. I'm not good at it. And the best fund managers in the world are only right about half the time. When it comes to sales, I think they're already pulling all the levers. So I guess they could, throw something in for free since they're losing less money on the promotional offers. They could extend the promotional offers. And I think that for people who are not using the promotional offers, their interest rates will improve as well. So I expect a modest improvement. But the other thing is, I think that there would be a better sentiment overall. Consumer confidence is key, is one of the critical elements to the health of an economy, to measuring it. And this may improve consumer confidence.
Yeah, just to give a quick update. Again, something I talked about last night with Randy Kirk. So now you're seeing everything kind of go negative, neutral. The Dow was just negative. So it's this normal seesaw you see. But I would ignore all this price action until Jerome Powell starts speaking. That's the real deal. And the other thing that I was listening to. So it seems like the odds for December will be another 50 basis point cut. At least that's what the odds are saying, apparently.
Mm-hmm.
But yeah, I think I think I'm pretty bullish going into 2025. I think I've said this a lot with you, Herbert, that I think we have moved out of this this pre FSD, robotaxi, AI world where we cared so much about the delivery numbers. We've seen this year multiple times that the delivery numbers have been irrelevant at this point, right? Tesla has disappointed hugely on one quarter, just barely met expectations on another quarter. We'll see what it is this quarter, but I think the narrative has moved away from vehicle deliveries, and we have moved into this. I heard Jim Cramer yesterday literally say that we all know autonomy is the future. We all know it's here now. Like, it's not even a question anymore. He's literally saying these words. I'm like, when did this happen, man? What you tell me when this was just a given now. Now, mind you, he didn't mention Tesla at all. He talked about Waymo. He talked about Cruise. He talked about some semi trucks. Okay. But yeah, the thing is, the narrative's changing. So I think the whole delivery thing is, at this point, it's interesting. It's something we need. It's important to the business, but I think it's going to start getting less and less attention, much how energy has never really gotten attention. And all the focus will be more on FSD, AI, robotaxis, Optimus.
Hey, there's nothing wrong with everything going right, though. And we were talking, Brian and I had a show where we shared with everybody where actually the more cars that are sold, especially now with the robotaxi, in that couple of years from now, you got the lower, more affordable vehicles, 2 of them being sold maybe, or first half of next year. Then you got the interest rate cuts. The more cars sold actually helps with autonomy. It will create the autonomous world go faster. So, let me, I'll share something here too, right? That, I think I got rid of it. So let me, while I'm ready for that, go ahead and cover for me there, Brian.
Why, of course. It's interesting to see. I've seen comments saying that, boy, they really should have cut rates a quarter in August to kind of smooth this step, especially if we're going to be doing another 50 basis points in a month and a half, 2 months. It's going to be chaos. But what Nick was saying is that it's priced into the market already. And I think what we've seen, and correct me on this because I don't have it in front of me, is that reductions had been priced in before, and then the market had a poor reaction when they didn't happen. So if this was anticipated, I'm going to just look at the Tesla stock real quick.
But we shouldn't be worried about
mildly up.
today, that doesn't matter, right?
Well, it
That's-
just reflects the sentiment, the short-term sentiment. And like Nick was saying, the market isn't moving as much as I would have expected.
You know, I want to ask you, Nick, because you had said that the month before 10/10, we should see the stock rise, because you said the month before 8/8, that's when everybody started buying the Tesla stock and it went up. Given the announcement today, doesn't that now give the permission for people who are, you know, a little weary about a recession coming or not? By the way, there's some stats that says that when you have a cut, that you do end up getting a recession. But regardless of that, but the point is that if you now give permission to people who are looking to grow stocks to actually start investing, we're now 3 weeks away from 10/10. Should we not start seeing the stock rise?
Yeah. So remember when I said that to you, Herbert, we were at, I think, 205. So I would say that 25-point move is definitely their 30-point move, essentially. So we have been moving. We're still a ways away from it, you know, in a short-term perspective. And then as far as the whole, you know, recession, when we cut rates, that's only after something broke. If you look at the history when we haven't gone into a recession after we cut rates, is when we cut rates before something forces us to cut rates. So that's a pretty big nuance. But regardless of what I said about what happened last time before 8/8 or what happens in the past with rate cuts, I believe so much that, yeah, the past is interesting, but it's just that it's interesting. It can be a guide, you know, maybe it's like putting your finger in the air, but I don't think that it indicates anything as far as what's going to happen in the future. I think the future has so many new variables that you can't really just tie a 1-for-1.
Yeah. So this table shows you every time there's a first rate cut, what's the chance of a recession every year, so, you know, whatever. And you can see that no recession 4 out of 14, but 10 out of 14, there was a recession. And what you're saying is, well, yeah, but it depends on what actually caused the recession if something actually broke. So you're saying that, you know, this doesn't mean that we're going to have a recession this year, right?
Correct. Yeah. I mean, the Atlanta Fed is just upticked their GDP to 3%. I mean, you know, that's not looking recessionary. Not saying it can't happen.
Yep.
Wait,
So
can I
in
just say one other
about-
thing real quick?
Yeah,
I know we're
setting it up so that people are aware that in about 9 minutes we will be watching this and we'll be playing this and we're going to see, you know, what they say. Yeah, hold on. It actually is working. I just have to start it off in
In a slideshow mode.
yeah, I have to do it this way first.
What a banger of a song. That's my jam right there.
Calm down, everybody. Calm down.
So,
Okay.
Herbert,
Yeah.
you mentioned what's happening today doesn't matter, but it kind of does, because historically, I don't hear anyone talk about this anymore. But back in December, actually, I heard you talk about this a lot. Normally, the stock market moves 6 months before the Fed starts to cut. So it is important to know where you are on a given day to day. And the reason today is so important is because today is the official signal of not only are we done raising rates, not only are we done pausing, but now we're going to move into what's probably going to be a more aggressive rate cutting cycle, which is a very big deal for how you position yourself in your portfolio. Maybe now is the time you decide you get more aggressive on certain stocks. Maybe you take money out of your money markets, start accumulating more. Maybe you're a little less worried about being so defensive and having,
Right.
you know, so it does matter for what's going to happen. Now, I'm with you. I don't think the given price action today and tomorrow is going to be kind of garbage, right? There's no real signal in that. But where the signal is in the fact that what rate cuts mean moving forward. And especially going into this period of the year, this is the most bullish period of the year we're about to go into. You know, with rate cuts, I mean, that's pretty awesome.
Yeah, it's like right now, the next several days, it's what's already built in and what's not already built in. But in the next week or so, it's going to be this more money flowing in, right?
Yeah. Okay. So CNBC just showed this. For November, there's a 62% chance of a 25 basis cut. And for December, there's a 93% chance of a 50 basis point cut.
Why only 62% for 25 basis cut? You just heard that the vote, 10 out of whatever it said that they're going to vote for another 50% basis cut in November.
And is this analysts that are saying this, or is this one person at CNN saying
Is
this?
it investors?
No,
or is
it's the Fed's projection. So it's on the Fed's fund. So I mean,
All right.
it's just odds trackers really.
Okay. 62% chance is going to be another 25% basis cut in November, as opposed to another 50%. 50 basis
Wow.
cut.
I will tell you though, like the market's really interesting. Netflix is approaching all-time highs. Meta's approaching all-time highs. Amazon's approaching all-time highs. Apple's slightly off. Nvidia is slightly off. Costco's approaching all-time highs. So the market's definitely, they're ready for some animal spirits, as they say.
Okay. So Tesla again,
Not near all-time highs.
Who here thinks that Tesla's going to change anything? Given the 50% basis point cut today, maybe in a new quarter, would we see them continue the 1.99% financing? Would they just pocket that as margin? Because now more people could buy it, regardless if they offer the 1.99% financing. Or do you think they might actually even give that to the consumer and say, hey, instead of 1.99%, it's now 1.25%?
I think they would give it to them. I think they want to expand deliveries any way they can while maintaining a positive margin. And I don't think they're in a position to be demanding a higher margin. I think this will especially help buyers of the more expensive things. The Foundation Series Cybertruck, the eventual non-Foundation Cybertruck, they don't need promotional pricing on this. Tesla interest rates are already competitive, but if they're not sufficiently competitive, you just go to your bank, and guess what? Your bank rate is lower next month than it was last month, and lower still into the end of the year. I think this positions the company nicely for a solid Q4.
Mm-hmm. Okay.
Yeah, I think I'm kind of in the same boat that they will. I would imagine they're going to mostly pass everything on to the end consumer. But I bet you that they play with it, right? Maybe 1 month they'll do one thing, next month they'll do something else. A couple weeks they'll do something. They'll be they'll move and they'll test and they'll see what works.
And at the end of the day, it's a benefit to us Tesla investors, right? Whichever they do. If they decide to keep the cash, then they got higher margin. If they decide to pass it on to the consumer, then you have higher volume, right? They can decide what they want to do with it. At the end of the day, I was saying to Nick that it does matter, because I know that car sales don't matter. Wait until we get Robotaxi, but both matter, and everything's happening that it's turning to the positive now, right? We went through the dark period. I don't want to knock on wood. I'm not saying we're past this stage, but we're looking like things are going to open up. We're going to have more car sales. Tesla had already, by the way, reminder to everybody, in the last earnings call, they're projecting a 3 million run rate of sales. That is 50% increase from this year. So
From this year,
yeah.
But Herbert, so the only thing I'll say is we can't have it both ways. All right.
Why not? Why not?
Because hear me out.
Why not?
Because if your only metric is how you're doing on vehicle sales, and that's what you want us to focus on, okay, that's one thing. If you want the market to focus on AI and FSD and all that, well, then that's another thing, right? And so we're going to have to deliver on that front, right? So 1010 is more important, in a couple days than it was this time last year, just because of that. So, I'm not saying that it's just 0 to 100, but it's probably more like 30-70, where now the AI part of it needs to prove itself out, and that's what the market's going to care more about. It's like, all right, you've conditioned us, you've told us this over and over, you're having a Robotaxi day, all right, start to show us something. So,
okay,
I think it matters.
So what's going to happen here, Nick? Why don't you set us up? What's going to happen in about 2 minutes from now?
Yeah, so what's going to happen is Jerome Powell is going to give his pre-written remarks. I don't know what he's going to do, right? 50 basis point cut. I think what he's going to aim to do is try to keep the market easy, try to show we're doing this out of a position of strength, not because we think something is broken. That's going to be extremely critical. because a 50 base point on the surface makes people think, uh-oh, what do they see we don't see? All right. Now, I think that's, kind of nothing, but I do think that Jerome Powell has to kind of be very straightforward that this is about moving from a position of strength, because now we want to make sure that everything's good when it comes to the labor market. Now they're projecting a 4.4% for 2025, up from 4%. So they do see more layoffs coming, a weaker jobs market. So that's very critical. From there, he'll take calls from pundits and media type, and keep an eye out for Nick Tribunone, or however you say his name. He's known as the Fed Whisperer, who the Fed supposedly sends leaks through. So listen to him. And I think Steve Leisman always has pretty good questions.
So what you guys are missing, and I can't believe no one's doing this, is using this inspirational music to just build the mood. It just sounds like
I'm going to raise it slowly as we get to...
sounds like I'm at one of those cool churches. We are less than 2 minutes away, probably about a minute away.
No, it's 30 seconds, yeah.
Okay, then yeah, if they start on time, we shall see. They usually do, though. So,
I mean, you've got the affordable car models, guys. This is cheaper, more affordable than the Model 3. This is going to come out in the first quarter. What happens what's the interest rate's going to be then, guys? What's the interest
it just
rate's gonna be
sounds
then?
so inspiring the way you say it.
All right. Looks like here we go. Okay, maybe not. Oh, here we go.
No,
No.
he's coming.
So that bald head in the front right, that's Steve Leisman.
This guy? Oh, this guy right here.
No,
Okay.
yeah, the bald.
Yeah.
Yes.
I mean, there's no
There it
noise,
is.
but there he is.
There he is. Oh, no notebook.
Uh-huh.
Oh, it's already up there.
But he does have his tactical glasses.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what?
Like I
should we make that
scripted it.
call? Thank you.
Exactly.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the 2 employment reports, July and August. We've also had 2 inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and
How
third?
do we make the, sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based
Sure.
on what shall we make that call? Thank you.
Sure. So, a couple things. A good place to start is the SEP. But let me start with what I said, which was that we're going to be making decisions meeting by meeting, based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
Go to Chris.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%, inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment, moving to a more sustainable level. so that the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard?
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year?
Yeah, we're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina.
Hi, Chair Powell. Gina Smilik of the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in a solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there, but so I would say we don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably under 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment and you ceased the balance sheet runoff, with a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply? Or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. By many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018, 17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
Okay, so we can stop this now. Basically, it seems like most of the questions are just reconfirming, clarifying why he made the decision. They cut 50 basis points. I found that he was very measured. He said that we weren't, acting in urgency. He's not going to tell you that we're going to continue this pace going forward. But at the end of the day, he repeated several times, right, that I think that the inflation is stable, and that I think that labor market and the economy is stable. And so I think at the end of the day, they're going to cut rates and they're going to keep things flat. And then hopefully that's what's going to turn out. But they feel very strongly confident that they've made the right decision, 50 basis point, which I think was the right thing to also. And then now it's just wait and see. So it's all good news. I want to talk about the impact of what you heard to Tesla. Do you want to jump in, Nick?
Yeah, sure. So first of all, again, I know everybody's looking at the stock market. I know you guys always hear me say, focus about the long term, not the short term, but I also understand human nature. You're looking at it. Don't take today as anything. Think about tomorrow as well. We so often see that however we end the day today, tomorrow, the exact opposite happens as the market really digests it, is what they end up saying, because they don't have a real answer. But with that said, that last question and answer was interesting, where he was saying that we need to keep an eye on the unemployment rate, and that, he's justifying that, this is where full unemployment tends to look like as far as, at the 4%. But unemployment is a sneaky one. Normally when that starts to tick up, that's when you kind of play catch up, because that's like the last thing that really starts to present itself. So that can be, and again, that's based on the past. I can't say this. I can say this on Blue My Face. Today's market, today's environment is vastly different than one yesterday's was, right? Or last year's, or previous, times in history. Now we have AI, right? AI is helping a lot of people be more efficient. We have the Elon Musk effect, what he did going into Twitter and gutting House, right? And you hear Larry Ellison talk about that. You hear lots of people talking about that. David Portnoy was just on with the All In podcast guys, and he said the same thing about what he did. So there is this change in environment that we're in. But as far as how this affects Tesla, I really think it's only going to be good. I think the best thing is that this is what you wanted going into 1010. Is from a stock perspective, we wanted to go in there with some wind in our back, right? And this is wind in our back. He's speaking confident. He's not too worried. Although I would say he's got to say that. But we got a nice big 50 basis point cut. We're rounding out the year. We're going to 1010. FSD's coming out. We're going to see a new vehicle, maybe multiple. We're going to go into the best quarter of the year, the best 2 quarters of the year for us. And then we're getting into 2025, where again, we potentially have FSD in Europe, in China, and we're supposed to have a 50% year-over-year growth. So there's lots of, wind to our back now. And as we go into 2025, potentially another 50 basis point cut and another 25 basis point cut. So I'm not saying that good times are here. I'm not saying, break out the champagne, we're going to all-time highs again. But I think we can officially today say that the worst might be behind us.
So what I'm seeing is, in addition to all the tailwinds you just mentioned, going into Q4, we're seeing more rate cuts on the horizon, very likely. The shift in sentiment from the Fed voters who supported this cut was very dramatic. It's kind of unimaginable to me that they would all be wrong. If it was a simple majority, I could see it being perhaps a mistake, but I'm not as concerned with it. And to address the 50% growth thing, Tesla's very good at doing things that they kind of have already done. It's when they do new things that it's very difficult. The Semi was new, difficult. Cybertruck, new, difficult. Taking the Model S and building the Model X was not as big of a leap. Doing the Model 3 and making the Model Y, it came out 1 year from the announcement. And building the Model 3 and Y lines in China, it's a copy of what we had in Fremont, more or less, easy. So if we're going to make a slightly different, slightly smaller, but based on the same platform, Model 3 or Y derivative that's less expensive, we could absolutely have that out on the streets next year. In time for a 50% growth, I don't know that part for sure, but just Cybertruck ramp is going to be a big chunk of that. Just increased sales on existing 3 and Y due to lower interest rates stands to do a big chunk of that, and I think it's all very possible and plausible.
Okay. What I'm thinking how it's going to impact Tesla, I think it's going to be very good news, because it is what you were saying earlier, that this is a milestone of the change in sentiment. And this is how it shows up. We're going to cut 50 basis point. And, you heard Powell saying, I'm very comfortable with where we're at in both unemployment and inflation. What's it going to do? Tesla's going to be much more aggressive now. They're going to be much more comfortable investing again. You heard Elon say, he's always ahead of the market. And he was saying, I'm not feeling, I don't know what's going to happen to the economy, so I'm going to pull back. You saw him not invest in Giga Mexico, not invest in Giga India. But good news was they continue to invest heavily in data centers and AI. I think now with the 2 new affordable models, with the 1010 coming out, and if this interest rates continue to go down, the economy looks like it's going to stabilize, and then people are going to improve, this could be when Tesla steps in and starts to put in the gas and start to invest again. I still want them to invest more in AI, but now we're going to see bots. We're going to see robotaxi development, and maybe this is where we're going to start hearing more of the unboxed factories being built now. You know what I mean? Like in the next year, it's less of this gloom. Whether or not it's going to be recession, though, that could be the new thing, right? Deflation and recession. But what we heard today was very comforting. What he said, the words, he didn't really say anything, right? All he said was, we'll see what's going to happen. But still, that was the message I got, was very comfortable with where we're at.
So I got to tell you guys about a dream I had last night.
Okay.
I promise this is related. Herbert.
Okay.
And Brian.
I was getting worried.
So last night I had this dream that I got invited to the Robotaxi event, and we're sitting there and we're about to unveil it and go into it, and they pull the sheets off, and what it looks like is one of those Jeep Wrangler pickup trucks. And I'm looking at it like, okay. And we get to go inside of it. And so like I walk up next to it. I'm like, this can't be right. And the doors that open, it's like a school bus. And I walk up and it looks like an RV, but like a 1970s RV. And it's got like all these chairs and seats everywhere, just kind of like at different levels. And there's a steering wheel. I'm like, this doesn't make sense. Like, this doesn't seem right. And I'm like trying to think objectively, like, okay, where am I wrong? Because Elon's this visionary, and a lot of people are having the same reactions. And I just hear Elon saying, "You'll see. Just mark my words. You guys, you don't understand, but you'll see in the long run." And then I'm sitting there, I'm like, okay, do I just trust him? And then all of a sudden, I see him walking away with Amber Heard, and it looks like they got back together. And I'm just sitting there thinking to myself,
"It's a nightmare."
Yeah, I'm just sitting there thinking to myself, "Oh my God, I think I need to get out of this investment." Yeah, it was.
And then they said, "Welcome to Jurassic Park."
Yeah. What's the moral of this story?
Where was this going, man?
Scared? Are you starting to feel scared about Elon's direction and where he's taking the company?
I don't know. The moral of the story is I can't wait till we see what it actually looks like.
Okay. All right.
I'm just letting you guys know what happened last night when I was sleeping.
No spicy food after 10 p.m. is the moral I got.
Okay. I'm on the other side. I'm much more bullish today than I was yesterday. We are hearing that we're going to hear rate cuts down. We're, like you said, tailwinds for the 10-10 event. I don't want to people have been very much overhyping what 10-10 is going to represent and what it's going to be. Even Elon himself. But I just still believe at the end of the day, even if it wasn't a major hit, 10-10, we're still heading into a fantastic year next year. Everything's heading in that direction. So,
do you really think it's getting overhyped? Because you don't hear the media talking about it or anything. I feel like how's it being overhyped? Like, I'm not even hearing what people think really for expectations. Like, it's like the expectations are they unveil a robotaxi and we get to have some rides. Like, that's not exactly a big deal. That's every event.
I'm going with Nick on this one. I don't think it's been overhyped, even in the Tesla bubble, even among the Ultra Bulls. We're still very tempered. We're saying, here's what I'd like to see, but I haven't seen anyone say any expectation beyond we will see a form factor. And I've heard plenty of people say we'll probably get rides. I don't know if I'd say that's not ultra hype. I'd say if anything, I think our expectations are tempered and reasonable.
Okay, I hope you're right, because if the general public's sentiment is that something big is going to happen and nothing happens, right? Buy the rumor, sell in the event, and that's what's going to happen. Stock will fall anyways. At the end of the day, what matters is we watch to see the business and the product. Are we headed in this direction? So that's why I keep saying to you, Nick, that what we see here is interest rates going down, and that's going to help with the car company part of it. And that delays the requirement that we need to have some autonomous robotaxi business model up and running by first quarter of next year. It could be delayed now because everything's looking good. Even the car business is going to go back to 50%. And now we're actually could even surpass that with affordable models at a time when interest rates are falling. So it's like a double whammy that we didn't have for the last several years.
Yeah. Yeah, I mean that's a bold thing to say, 50% year on year. I mean that's only going to come with new vehicles. So
Elon said
and
it, right? Your earnings
no,
call,
no,
they said 50% next year. So it's not me coming up with that number. Tesla did.
yeah, no, but
So,
that's what I'm saying. Like that yeah. I mean that leads me to think that they better start taking orders sooner than later.
yeah.
So they got to
Okay.
unveil something sooner than later. And by the
All
way,
right.
the market's essentially going red now.
Okay. It's, all right. So thank you, everybody. Stay on right now. We're going to close this out, but you're going to get right sent to Futuraza, and he can answer questions that people have. Thanks, everybody. Bye-bye.
Cheers.
Thanks, everybody.